What's going on, champions? Welcome back to the channel. Today we're talking about the US economy, inflation, Federal Reserve, and your money. So if you are concerned about what inflation is doing to the economy right now, you are at the right spot. And if you are also worried about how the inflation is going to be handled by the Federal Reserve, you are at the right spot too. And if you are concerned about your money and what exactly is going to happen after the Fed's meeting, you are at the right spot. So let's jump right into it. According to this report from CNBC, the Fed is meeting this week, and there are some expectations that financial experts are looking forward to when it comes to this meeting. So what are the key points here? According to this report, the Federal Reserve meeting this week is expected to be the unwinding of the massive economic lifeline, the economic help that has been provided during this pandemic. So the expectation will be that the Fed is going to cut down on most of the, economic help, the massive economic, stimulus, and some of the lifeline that it has extended during this past 2 years. And some of the unraveling events in the world right now, especially the invasion of Ukraine, has really been a major concern to most experts. In fact, there's mixed opinions and mixed reactions when it comes to, will the Fed be increasing interest rates given what's happening in Ukraine right now? And Federal Reserve Chairman Jerome Powell does not intend to hold up. He's actually expected to increase interest rates, according to the reports and the signals that has been put out there by the Fed. So this is something that most people got to be paying close attention to. And right now, the expectation, according to experts and according to this report, is that officials are projecting that inflation would run to 2.7%. By the end of the year, which, to me, this is maybe not realistic if you ask me. But again, we're going to keep my opinion aside and talk about the real facts and the real data and what experts are saying right now. So before we get into some more details here, let's quickly talk about this. So the Federal Reserve is expected to meet March 15th to 16th. So basically this week and today precisely, the Fed is supposed to be meeting to talk about the economy and how to help the economy, how to basically course correct, especially with this crazy inflation. So what impacts are we going to see when it comes to the increase in interest rates, which is the big thing that is around the chopping block right now? Savings rate, we're going to talk about how. Again, before we jump into this, right? This image right here on the screen that you're looking at right now is from Fidelity, right? Just want to make sure I give credit where it's due. And basically, this goes to talk about how higher interest rates will impact your bank account, what it means for your money. And just for those of you who are not aware, higher interest rates is, in short, increase in the cost of borrowing, right? Because you pay interest when you borrow money. And if you are not borrowing money, you may be thinking, oh, this is good for me. Yes, it's good for you in a way if you are a saver. But it's not too great for savers either, given inflation, because cash in the bank is not good in times of high inflation. So you got to pay close attention to this, right? So let's talk about some of the indirect impacts that we're going to see. And the direct impact is the federal funds rate increase. So the federal funds rate is the interest or the rate that's charged that banks charge themselves, right? Typically overnight when they borrow money from each other overnight. And this is basically what most of the the loan products like mortgages and some of the interest rates are based off of. So they are all based off of the Fed funds rate. So what the Fed is meeting today is to determine if they're going to increase the federal funds rate. So the Fed fund rate, that's what you're going to be hearing about in this video. And I'm sure you've heard about it through other sources as well. But the real impacts, the indirect impacts that this will have on the masses, on the American people, will be savings rate, right? We talked about savers are going to see a slight increase in interest. So if you have money in the bank right now, you're likely going to see a slight increase in the interest that's paid out when the Fed increases this interest rate, the federal funds rate. And if you are really looking for the real adverse effects, we're going to talk about things like student loans. So what does it mean? If you have student loans right now, or you're going in for a new or you're applying for a new student loan, existing federal loans are fixed and the charges won't be changing, right? But interest rates on variable student loans, so variable rate loans, will likely be going up. So if you have private lenders that if you are borrowing from private lenders, you're likely going to see an increase, and that's if you have a variable rate, right? And that's something that we're really going to see right now. But for existing loans, I just got to make sure that this is clear. For existing loans, nothing is going to change. Now, when it comes into, and these are federal loans, existing federal loans, right? Not private loans. Now, when it comes to mortgages, this is the big one, right? We're seeing things like refinancing pretty much going up and down depending on how people really taking this whole Fed funds rate hike. But auto loans, mortgage loans, these are going to be the ones that will show the quickest, change. Credit card charges, right? Charges on credit card balances, we're going to see this kind of go up, and we've already seen some of these, moving, in the higher direction. So we've seen banks and financial institutions increasing the charges on credit card, the fees on credit cards. So that's one thing. Now the mortgages, this is something that goes in lockstep with the federal funds rate. So these are some of the key impacts, or some of the things that you will see when it comes to the impact of the rate hike on your money and your bank account. So now that we know that, let's take a look at what this does to the stock market. According to this report here, or this bar chart, this data from Fidelity, when you take a look at the stock market performance and how the rate hike has impacted, or in the past has impacted the stock market performance, you're going to see some type of metric, or some type of outcome that will help you predict what will happen in the next few months and years to come. So basically, in 2020, we did see, in March of 2020, we did see the Fed lower interest rates. Interest rate was pretty much, the federal funds rate was right around 0% to 0.25%. And what we're seeing right now is that with the federal rate hike, we're going to see a decline in the stock market performance. So you're likely going to see a huge slowdown 3 months after, according to experts. So just take a look. 12 months prior to the Fed announcing the rate increase, we did see the stock market, and this was in 2020, right? 2020 to 2021. We did see a huge performance, a 20% performance in the stock market. And then 6 months before now, we did see around, something shy of 15%. And as the news of the rate hike basically catches up with people, we're seeing even lower stock market performance. And lately, we've been seeing significant stock market volatility. So right now, when it comes to what we're expecting going forward, we're looking at, in the next 3 months, according to experts, somewhere less than 5% in terms of market performance once the Fed raises the interest rates. Then 6 months after the Fed raises the interest rate, remember, this is going to be a gradual interest rate hike according to the Fed. The Fed is not expected to just slam one big rate hike. No, it's right around 0.25%. So a 1/4% in increase. So that's really what we're seeing. And this will be done gradually over time. So this is not going to be a one-time thing this year. It's going to be a few times this year. And the goal right now is to basically smash this crazy high inflation. Remember, they came out before and said inflation is transitory, but that's not the case. we've seen that it's not really transitory, right? That term has just faded away. And this is a serious issue, especially in light of the Russian invasion of Ukraine. So what are we going to see 12 months down the line? According to experts here, this data basically predicts that 12 months after the federal rate hike or the federal rate increase, we're going to see the stock market returns rebound to around, over 10% in terms of performance. Now, 2 years down the line, this is a bold prediction, right? And this is all based off of historical stuff that's happened between 1950 to 2021. So we're likely going to see a rebound in stock market performance to around over 20%. So again, let me know your thoughts about this in the comment section. Do you think this is really true, or what are your personal perspectives with all of this stuff that's going on right now? So again, this has been really, interesting to many, especially the financial experts and those who are in the investment world. And for the average person out there wondering, how is this going to impact me? We've talked about it. If you've got money in the bank, you really got to be concerned too, because inflation is going to eat into the value of your money. But with the interest rate increase, you're going to see a slight increase in the interest the bank pays you to keep your money. And if you are a borrower, you just have to know that the cost of borrowing will be on the increase. The cost of borrowing will go up with this move from the Fed. So let me know your thoughts about this in the comment section below. I hope you took some value out of this. See you in the next video. Stay safe and keep winning.